Types of derivatives. There are various types of derivatives that are displayed in this slide: forwards, futures, options and swaps. Forwards are customized agreement between two parties. Now, the terms and conditions might vary from person to person, and it might vary from location to location. So, forward is actually a unregulated contract between two parties. Futures is actually a standardized contract. So, future buyer has an obligation to meet the contract terms. Option buyer, there are two types of options: call option, put option. Option buyers, they have the right but not the obligation to do as per the contract. The last type is swaps. Now, we have two types of swaps: currency swap and interest rate swap. We will see in detail in the coming slides. Forwards. Now, we are going to see something about forwards. It is actually a contractual agreement between two parties to buy or sell an underlying asset at a certain future date for a particular price that is pre-decided on the date of a contract. Now, let us take an example. A farmer is entering into an agreement with a wholesaler to sell 10 tons of wheat after 3 months. So, he will decide on a price, and that price will be agreed upon by the wholesaler, and that price will also be a part of that forward contract. So, this contract is an example of a forward contract, and this contract has a customized terms and conditions. Now, the farmer in South India might enter into a contract with specific terms and conditions which are different from a person in East India or North India. So, it varies from location to location, it varies from person to person. So, forward is a customized agreement. Now, we will see in detail about the limitations of the forwards. Now, in this slide we have listed down all the limitations of the forwards. First, we have liquidity risk. Liquidity means the ability to change immediately into cash. So, that is the liquidity risk. This forwards cannot be immediately liquidated. This forwards cannot be immediately reversed. Now, let us take the previous example, the farmer and the wholesaler. The farmer cannot reverse his decision that is made on the agreement, and the wholesaler cannot go back on that agreement. The wholesaler already agreed to buy 10 tons of rice after 3 months. He cannot go back on that agreement, and the farmer cannot go back on his agreement. So, it is not possible to reverse the contract. So, that is the liquidity risk here. The second one is the counterparty risk. For the farmer, that wholesaler is the counterparty. For the wholesaler, farmer is the counterparty. Now, there are two scenarios here. The farmer may correctly deliver 10 tons of wheat after 3 months. So, he has completed his obligation, but the wholesaler can default on that payment. So, that is the counterparty risk. On the second scenario, the wholesaler might be ready with the money, might pay the farmer also, but the farmer might fail to deliver 10 tons of wheat. So, that is also counterparty risk for the wholesaler. So, these kind of risks exist in forward contracts. The third one, no regulation. No regulation. These forward contracts are not regulated by any government authority or any regulatory authority. The fourth point is there is no settlement guarantee. Now, this settlement guarantee fund is actually there in stock exchanges. This concept is not available for forward contracts. It is not available because forward contracts are not regulated by any authorities. So, that is why we do not have any settlement guarantee fund that governs all these contracts. So, these are all the limitations of forwards. The next slide we will see something about the swaps. Now, swaps are agreements between two parties to exchange cash flows in the future according to a pre-arranged formula. So, swaps means You should remember that it is just exchange of cash flows. Now, they are portfolios of forward contracts. So, portfolio means you have a basket of forward contracts. That particular portfolio might have 4 or 5 forward contracts. Now, we have two types of swaps, there are interest rate swaps and currency swap. Now, what is the interest rate swap? Swapping only the interest related cash flows between the parties in the same currency, that is called as the interest rate swap. So, interest rate swap means swapping only the interest rate part, and the second point that you have to remember for interest rate swap is it is within the same currency. Now, the second type of swap, that is currency swap, it is about swapping both principal and interest between the parties, and this exchange happens between different currencies. So, interest rate swap happens between same currency, but currency swap happens between different currencies. So, these are the two types of swaps available.